Welcome to the market update for August. I'm Gordon Toy, and with me is Bill Keenan, General Manager of Direct Equities Research, to bring us the latest market developments. Bill, welcome.
Thanks, Gordon. Great to be here.
Bill, obviously we've seen the markets rallying recently in July, post-Brexit. What's been behind these gains?
Yeah, it's been a pretty strong rally actually when you look at the market, the Australian market up 6% in July. I think there's been three key reasons for that. One, interest rates have moved much lower globally post the Brexit situation in June. So we're seeing global bond yields across Europe, Japan, US and Australia have moved much lower, and that's supportive of stocks. The other thing that's at the time, remember there was a lot of political uncertainty in the UK in terms of Cameron resigning and Labor itself there in a bit of turmoil. Then in Australia we had a bit of a uncertain election result, and this was all happening at the same time. So as we move into July, we've seen that a lot of that political uncertainty, some of it's been resolved in terms of the Australian election. There's a firm result, and also Cameron's been replaced by the new Prime Minister in Theresa May. The third thing that we've seen is the strong US data in July has come through in terms of strong payrolls result. Manufacturing and non-manufacturing surveys have improved. So the US data has improved. It's given the US market stronger confidence, and that's led the way in July.
And looking at commodities, we're seeing some mixed signals with gold rallying and oil pulling back. How do you explain that divergence?
Yeah, it's interesting that commodities are giving real mixed signals now, and we've seen gold put on a strong rally actually in July. And I think gold's rallying because of these European issues that have come up, political issues, structural issues there. Longer term, I think people are concerned still about the European situation, and gold is getting a bit of a bid in terms of that uncertainty, that political uncertainty. We've also seen though that the central banks around the world have continued to ease liquidity and also venture down the money printing path. And I think there's a bit of a worry behind the markets that currencies are at risk of devaluation in terms of the key currencies like the pound, which depreciated quite rapidly after Brexit, but also the euro, the yen and the Japanese yuan are all at risk of devaluation. So I think gold, in terms of an absolute store of wealth, not able to be manipulated by the central banks of the world or the governments of the world, is getting a bid as an absolute store of wealth.
So are we seeing central banks engaged in a global currency war at the moment?
Yeah, there does seem to be a global currency war going on behind the scenes where no one's really talking about it, but it does seem that everyone's trying to get their currency down to make themselves more competitive. And if we look at oil's been a bit different, where the fundamentals have actually come in again in terms of oversupply. So the market has been looking at the rig count in the US has been on the rise again after falling for the last year or so. And then there's been some other things where some production outages have a few countries have come back online. These are Canada, Libya and Nigeria. They've all started to increase their production again. So for that reason, oil's actually gone the opposite way to gold and started to retreat back to the $40 a barrel at the moment.
And obviously we've seen the RBA cut the cash rate by 25 basis points at its August meeting to a new record low of 1.5%. What was behind that decision?
Yeah, it's actually an interesting decision because when you look at the data prima facie, growth is still pretty strong in Australia and the housing market is fairly buoyant. So you ask yourself, why are they cutting rates? Well, they're actually concerned about the outlook in terms of global growth is slowing outside of Australia, but also inflation. Inflation now in Australia has just come out as 1%, which is very low.
Incredible.
The Reserve Bank's target range is 2 to 3%. So they actually need to get inflation back up to that 2 to 3%. So that's why they're cutting now and trying to get some stimulation into the economy and get prices moving up. They seem to be comfortable with the housing market in that they believe that the apartments coming into the market, particularly in the big cities of Melbourne and Sydney, will slow the property market. So they don't seem to be concerned about the housing market. And as we mentioned, there does seem to be an element of global currency wars going on where if they don't cut rates, then the Aussie dollar is at risk of rising because all the central banks around the world are aiming to get their currencies down. So they need to participate in that, and that's why they're cutting also. And actually, the market probably expects more rate cuts, believe it or not. Because the cash rate in Australia, even though at 1.5%, it's still high relative to most of the developed economies in the world.
Yep. And we have Australian earnings season nearly upon us. What can we expect for the outlook for FY16?
Well, in aggregate, when you look at the market earnings forecast, it doesn't look good. It looks like another down negative 9% earnings growth in aggregate. So it'll be the second year in a row that we've seen earnings fall in aggregate. So it doesn't look that good. But you've actually got to look behind it a bit, because materials and energy, that are the big part of the market, are actually holding the numbers down. And so if you strip out resources out of it, the market growth is actually around 5%. Earnings growth. And then if you look at the market and look at it on a non-weighted basis, so some of the big market caps obviously influence the aggregate earnings. If you look at it in just a non-weighted basis, earnings growth is around 7%. So I guess what we're saying is that on aggregate, the market earnings doesn't look good, but outside of the top 20 and outside of the resources, the growth is actually pretty good. It's around 7 to 9%, so it's not too bad. But it's just the top end of town that's keeping the market looking in the doldrums at the moment.
And turning now to the global outlook for equities, what can we expect in FY16?
Well, it's really a mixed, patchy outlook at the moment. I think it's pretty clear that Australia and the US still look pretty good as economies, and the companies and the markets still look reasonably good value. So we're still pretty positive on the US and the Australian outlook. However, when you look across the globe, there's obviously the major risks reside in Europe and also Asia. We've talked a bit about Europe and Brexit and some of the structural political issues going on in Europe. But also in Asia, there's concern about debt levels or non-performing loans in China. And in Japan, obviously, they're battling deflation there and, continual sort of slow growth and deflation.
And the major fiscal stimulus package that we've seen.
Yeah, they're trying to get things going with the government there. They're obviously money printing again and also strong stimulus. So the risks are clearly in Asia and Europe. So that's where, the risks lie for the equity market. But overall, I think we're positive because the US is the major leading market. So we remain positive on the outlook, mainly on the lower interest rates. The next major event after the profit season that we talked about will be the US election coming up in November. Could be a big issue for markets.
Well, it looks like it's going to be some interesting times ahead. That's it for our August market update. Thanks for watching, and remember to tune in next month for the September market update.